Hello and welcome. You're watching a very special segment, Meet Your Fund Manager, and today it's going to be all about the debt side of your portfolio or the debt allocation, fixed income allocation of your portfolio. And looking at the rate cut scenario with all the uncertainties around, how should you be placing bets as far as fixed income is concerned, and especially for those investors who are trying to revamp or reshuffle their portfolio and maybe have a larger chunk of money or exposure on the fixed income side. What are the kind of investment instruments you can actually bank on, and how should you strategize your portfolio as far as debt funds are concerned? Let's decode all of this. I have Devang Shah from Axis Mutual Fund, a pioneer in this particular sector, who's going to advise you today. So Devang, hi, good evening and welcome to the show. And okay, so it's going to be all about debt. I first want to ask you about the rate cut scenario that we are into, and especially looking from an India's perspective, where we've seen, inflation cooling down, more aggressive rate cuts on the cards. How are you looking at it? How are you assessing it?
Thanks, Kavita, first of all, for having us. Yes, you rightly highlighted and alluded on the point that we have significant easing on inflation and significant cooling on inflation over the last few months. We are also anticipating the inflation to remain significantly under control for the next 3 to 6 months. In fact, RBI also projects the same. Our projection is probably lower than RBI also. But we also need to probably just do a recap. In the last 6 months, RBI has done a great job of monetary easing on all fronts. They have actually significantly infused liquidity. In the last policy, actually, they did two things. One, they did a 50 basis of rate cut, as well as they've announced a CRR cut of 100 basis, which will be implemented from September. If I look at all the policy actions put together, they have infused more than 10 to 12 lakh crore of liquidities into the system since December last year. And they have also done 100 basis of policy rate cuts. So my understanding is a large part of the rate cycle or the rate cuts is behind us. They front loaded the rate cut because they wanted to support the economy and wanted the policy transmission on the rate side. So the lending rates come lower. So how do we look at it? Yes, inflation continues to remain lower. Growth continues to remain sideways and some of the indicators have remained muted for this quarter. But we believe that because RBI has done a front loading, in this policy, they might choose to continue to remain on a pause mode and probably look for incoming data going ahead. If there are surprises and shocks on the growth side, and we see a significantly lower growth number than RBI projection, and if we see again some headroom on the inflation front, we might see RBI cutting rates by another 25 basis in the second half of this financial year. That is how I look at monetary policy going ahead.
All right, so more 25 bits in the second half of this calendar year. But having said that, we are also seeing global headwinds now. Do you think that's going to derail the plan?
So again, rightly pointed out, because we're seeing some bit of uncertainty on tariffs, on the global headwinds, Fed hasn't started the rate cut cycle yet. And in this year, they have been on a pause for the last 6 months. And that is why we believe so that RBI would want to choose across for a pause at this monetary policy, look at what's happening on the global front, understand and decode what's happening on tariffs. Let's look at the US economy, the trajectory from Fed, and then probably act if the growth significantly weakens with some policy easing, monetary policy easing of 25 basis and some bit of continuation on the liquidity stance. So that is where we believe so. Again, global front, what we also need to analyze and understand is that US data has started to weaken. And if you look across at larger data points, which is on the growth side, some bit of employment and inflation hasn't inched up as much as all of us feared that because of tariff, there will be a significant rise in US inflation. That has not happened. So in that context, we also believe that Fed will start cutting rates starting September. And with that, there might open up some room for RBI to look at one rate cut. But because RBI has done so much of front loading and has significantly eased liquidity, we believe that this policy would be on a pause mode for RBI.
All right. Now, having said that, I really want to understand the way one should go ahead, because see, there's a lot of uncertainty around whether it is a debt market, equity market. People are really bullish on commodities as far as silver and gold are concerned. But having said that, from a portfolio level, what is the right what will be the right kind of strategies? Last few years we've seen any asset class you've touched, Devang, we've seen money coming in. Okay, we've seen good returns over there, be it equity, be it debt, gold, silver, for that matter, even crypto. But having said that, this particular year, from the very beginning, has been very uncertain. We've seen geopolitical tensions, we've seen the tariff uncertainties. Now, the second half of this year again is very promising, especially for domestic facing themes. There can be news flow that the global news flow, from a larger perspective that might impact our market, but our market's equity side at least is getting very matured. Now, having said that, is it time to go heavy on fixed income? Or you think that it is time to secure your gains from equity and maybe not exactly go heavy, but then for safety purpose you can park some money in debt? I mean, it is case specific, it depends on your financial goals and the aligned strategies that you might have with the portfolio. But talking about a time frame of 6 to 8 months, can we bank our profits from equity in debt? And if that's the case, what will be the right kind of investment instrument?
So, a couple of questions, Kavita, as you highlighted. I think first and foremost thing, which you rightly alluded on, this is a year of uncertainty. It starts with geopolitical uncertainty. It starts with tariff. There are many other issues on the global front. Even India growth has not picked up in a way which all of us anticipated. We thought that somewhere down the line, monetary policy easing will take its course and lead to higher consumption pickup. We also saw some tax relief from finance ministry in the earlier part of the year through budget, but it is not all kicked in into growth cycle. So in this environment where it is uncertain, and you rightly pointed out, in last 4 years, every asset class has made a lot of returns for investors. This is a year to preserve your returns. And that is why we believe so that yes, fixed income continues to remain a good choice for investor as an asset allocation. Now, depending on their age, depending on their goals, I think obviously you can fine tune your asset allocation, but that should be a part of your portfolio currently. Now, the only point which I like to highlight is that debt has also given phenomenal returns over the last 15, 18 months. If you look because of the monetary easing, of our bonds getting included in JP Morgan, because of fiscal consolidation, there has been a huge rally in bond markets over the last 12, 18 months. We have seen around yield curve lower by around 75 to 100 basis across the curve. So our belief is incrementally from here on, first of all, investors need to understand that returns would be muted. But yes, as an asset allocation, debt should be there into the portfolio. Now the question comes across, which is the second part of your question, is that if debt should be as an asset allocation used in this year, what part of the curve and which schemes investors should focus on? Thanks to the finance bill and the SEBI categorization, there is a new category which has come in, which is income plus arbitrage fund of fund category, where a large part of the portion, which is up to 65%, is in debt, and the balance 35% is in arbitrage. This fund category, as per me, is a very, very good, low volatile, tax optimal solution for investors who are looking for investments in debt portfolios. The only thing which we need to focus on is that for the tax efficiency to kick in, I think they need to hold on their investments for 2 years. So if you have an investment horizon for 2 years, and if you're looking at preserving your returns, which you have made over the last few years, in an uncertain environment, income plus a debt plus ARB, or an income plus ARB, a fund of fund category, as per us, is the best and a one-stop solution for investors from a debt market perspective.
How does this particular fund works? If you could just decode it in simple language for all those who are not familiar with it.
Yeah, so this is the fund of fund category where up to 65% of your investments will be invested in debt funds. The debt funds will be across, like, depending on your macro view. Like currently, I think in this environment where a large part of the rate cycle is over and the liquidity is significantly ample thanks to all the actions by RBI, the debt part will be invested in 2 to 5 year corporate bonds, which will be probably giving you very much similar returns like a corporate bond fund or a short-term bond fund. So that is the debt portion. The balance 35% portion will be allocated in arbitrage. The combination, as per the SEBI regulations and the tax and the finance bill, with the 65-35 combination, if you hold for 2 years, the implied tax rate on your returns is at 12.5%. So the tax efficiency kicks in if you hold your investments in this fund for more than 2 years. This takes you back to somewhere pre-March 2023 on the tax rates for debt funds. So this solution comes out to be a good solution as per us, where 65% remains in debt. It is a corporate debt or a short-term kind of a category currently. 35% is in arbitrage. This category is a significantly lower category, gives you similar like debt kind of returns, and with the tax efficiency kicking in for an investment horizon for more than 2 years.
All right. Now, having said that, a lot of times investors try and compare returns from a debt mutual fund with a fixed deposit. Looking at the rate cut scenario, fixed deposit might not be the right kind of investment you want to have in your portfolio. But having said that, the indexation benefit has gone away from a debt mutual fund investment. Now, how would you like to explain that despite this going away, debt mutual fund is still a good category post taxation as compared to a fixed deposit in a rate cut scenario?
So, as you rightly alluded on, with the rate cuts, in fact, in India, or I would say in capital markets and in India, the only way if you can capture easing of rates or rate cuts, or somewhere the benefits of capital gains on account of rate cuts, is through the mutual fund route. Because if you invest in any other traditional solutions like bonds and other traditional options, you will be locking in yields, but you will not get any benefit of the mark-to-market gains. So mutual funds gives you that benefit of capturing the rates cycle. Second, a most important perspective is that mutual funds offer you a significant ease on entry and exit. Like somewhere down the line, most of the funds you can deploy on a T+1 basis. Similarly, you can redeem on T+1 basis. There are no hidden charges, no penalties, nothing like that. Third, when you're investing in a mutual fund, the significant benefit is of diversification. Like you are investing into a portfolio which owns 50, 60 securities as compared to a traditional solution where you're investing all your debt money into one option. So when I look across at from a benefit perspective, riding the entire interest rate cycle, diversification, and ease of liquidity without any prepayment or penalty charges are the huge benefits of investing in mutual funds. Now, the second point which I'll try to allude on is that and I'll repeat for the benefit of investors, that with this introduction of this category, which is income plus ARB, fund of fund category, you are actually also getting benefited on the tax piece. You are getting a tax optimal solution for an investment horizon of more than 2 years, where your taxation rate will be at 12.5% as compared to marginal rate for fixed deposits. So our perspective is that when I look across now with an option of diversification, ease of liquidity, capture of interest rate cycle, and a tax optimal solution, mutual fund stands out to be a good option for debt investments as compared to your traditional solutions.
All right, let's move on. And I know we're talking about fixed income, but I really want your view on gold and silver, because this is a question we really cannot miss out looking at the kind of trajectory now. Silver is also in a great run as far as the current trajectory is concerned. But having said that, it's a very volatile commodity as well. Should we be giving more thrust towards these two metals also? See, from an investment point of view in a portfolio, you definitely should be having 10 to 15% of exposure, okay, depending on your core portfolio. In terms of diversification, you should be having it. But a lot of investors, and you know how the investors' mindset also work, Devang, whatever is going on well in the market right now, whichever theme is running, they will just, hold on to it and just get it in the portfolio. But we are talking about having the right strategies. We are talking about having the right kind of diversification. Time to go heavy slightly on these two commodities?
Yeah, so see, actually, as you rightly highlighted, I'm more a fixed income expert, but I'll tell you our thoughts on commodities. Sure. What we believe so is, first of all, you rightly pointed out that it is a good asset allocation to have always on your portfolio. And somewhere down the line, it is an asset if someone wants to actually hold any asset in dollar terms, okay? Because a retail investor, it is very, very difficult to have any kind of dollar exposure. gold allows you or silver allows you to have that exposure in a dollar in dollar terms. So I think it somewhere down the line provides you a hedge against currency. In this environment where people are worried about tariffs and rise in inflation, it can provide a hedge against inflation. And somewhere in an uncertain time where growth continues to remain weak, people are concerned about dollar, people are concerned about the entire US Treasury yields. I think at this point of time, we can have a slightly higher allocation towards commodities. But yes, we need to keep in mind that commodities have given, like I think probably gold has given more than 25-30% return in the last 1 year. Silver has again given more than 20-25% kind of return in the last 1 year. So our perspective is that yes, from a medium term perspective, diversification and a higher allocation towards commodities can happen. But we need to understand that in the near term, it can provide some volatility and the near term returns can be slightly muted.
All right, Umang, I do have a lot of questions for you, but then it's time up for this segment on the show today. Thank you so much for taking time out on the Money Show and helping our viewers with strategizing the debt allocation in the current scenario. Thank you.